The NASDAQ peaked in March of 2000, and then it fell. It fell 78% over the next 2 years. Companies that had been worth billions became worth nothing. Life savings were wiped out. And all those people who thought I was a dinosaur, a lot of them learned a very expensive lesson about the importance of understanding what you own. If I could give you just one rule that would save you more money than anything else in investing, it would be this: never invest in something you do not understand. Sounds simple, right? But every single day, smart people ignore this rule. They buy stocks they cannot explain. They chase trends they do not comprehend. They gamble on technologies they know nothing about. And they lose fortunes. Today, I am going to explain why staying within your circle of competence is the single most important principle in investing and how you can apply it starting right now. Well, hello there. Thank you for joining me today. You know, I have been asked thousands of questions over the years. Questions about markets, about businesses, about when to buy, when to sell, what the economy will do next year. And I always try to give an honest answer. But if there's one question that comes up more than any other, it is this: what is the single most important rule for investing? Now, people expect me to say something about buying low and selling high. Or maybe they think I will talk about finding great companies at fair prices. And sure, those things matter. But if I had to boil it all down to one principle, one rule that has saved me more money and more heartache than anything else, it would be this: never invest in something you do not understand. That is it. Simple as that. And yet, I cannot tell you how many people ignore this rule. Every single day, they hear about a hot new stock. A friend at a barbecue tells them about some cryptocurrency. They read a headline about artificial intelligence or quantum computing or some new technology that is going to change the world. And what do? They open up their brokerage account and they buy it. Just like that. And when I ask them, do you understand how this business makes money? They look at me like I just asked them to explain rocket science. Because the truth is they do not understand it. Not really. They just know the stock went up 20% last month, and they do not want to miss out. Now, I call this the circle of competence, and it is not a complicated idea. In fact, it might be the simplest idea in all of investing. But let me tell you, it is also the most violated rule I have ever seen. So what exactly is a circle of competence? Well, imagine you are standing in the middle of a circle. Everything inside that circle represents the things you truly understand. The businesses, the industries, the products, the economic models. You understand how they work. You understand how they make money. You understand their competitive advantages, their risks, their customers. Everything outside that circle, that is everything else. That is the stuff you do not understand. And here's the key. The size of your circle does not matter, not one bit. What matters is knowing where the edges are. I have said this before, and I will say it again. It is not important how big your circle is. What is important is staying inside of it. You do not get paid extra points for degree of difficulty in investing. You do not get a better return because you invested in something complicated. Let me give you an example. I understand insurance. I understand railroads. I understand simple consumer businesses like Coca-Cola and See's Candies. I know how they make money. I know what makes them durable. I know what could hurt them. These businesses are inside my circle. But you know what is outside my circle? Most technology companies, biotechnology, pharmaceuticals in many cases, and I am not embarrassed to say that. In fact, I am proud of it. Because knowing what I do not know has saved Berkshire Hathaway billions of dollars over the years. People used to criticize me in the late 1990s. They said I was out of touch. They said I did not understand the new economy. And they were right. I did not understand it. But the difference was, I admitted it. I said, I do not know how to value these internet companies, so I am not going to buy them. And you know what happened? The bubble burst. People lost fortunes. And Berkshire, we were just fine. So why do people keep breaking this rule? Why do smart, educated people invest in things they do not understand? Well, I think there are a few reasons. The first one is what I call the fear of missing out. People see their neighbor making money on some stock they have never heard of, and they feel like they are being left behind. They think, if I do not get in now, I will miss the boat. And so they jump in without doing the work. The second reason is that people confuse understanding a product with understanding a business. Just because you use an iPhone does not mean you understand Apple's business model. Just because you shop on Amazon does not mean you understand how Amazon makes money or what its competitive position really is. Using a product and understanding the economics of the company that makes it are two very different things. And the third reason, frankly, is ego. People do not want to admit what they do not know. They think that if they are smart enough, successful in their own field, then surely they can figure out any business. But investing does not work that way. You know, Wall Street loves complexity. They absolutely love it. The more complicated something is, the more they can charge you for it. They will create these derivative products, these structured notes, these collateralized debt obligations, and they will use fancy language to describe them. They will hire people with PhDs in mathematics to build models, and then they will sell these things to investors and say, trust us, this is sophisticated. But let me tell you something, complexity is not sophistication. In fact, in my experience, complexity is usually a way to hide risk. It is a way to make something that is actually quite dangerous look safe. And when you do not understand what you are investing in, you have no way of knowing whether you are being sold a good deal or a terrible one. I think back to the financial crisis of 2008. You had all these smart people at big banks buying mortgage-backed securities. Now, if you ask them, do you understand every mortgage in this pool? Do you know the creditworthiness of every borrower? The answer would have been no. Of course not. These pools had thousands of mortgages, but they trusted the credit ratings. They trusted the models. They thought, well, housing prices always go up, so what could go wrong? Well, we all know what went wrong. And when it did, these supposedly sophisticated investors had no idea what they actually owned. They could not tell you which mortgages were good and which were bad. They could not tell you what their securities were really worth. They were flying blind. Now, contrast that with how I invest. When Berkshire buys a business, I want to understand it so well that I could explain it to my grandchildren. I want to know how the product is made, who buys it, why they buy it, what the competition looks like, what could change in 5 or 10 years. If I cannot explain it in simple terms, then I do not understand it well enough to invest in it. This is not a new lesson, by the way. History is full of examples of people losing money on things they did not understand. Go back to the 1920s. Everyone wanted to invest in radio stocks. Radio was the hot new technology. It was going to change the world, they said, and they were right about that. Radio did change the world, but you know what? Most of the radio companies went bankrupt. The technology was great, but the business models did not work. And investors who did not understand the difference between a great technology and a great investment lost everything. The same thing happened with the dot-com bubble in the late 1990s. People were buying internet stocks left and right. Companies that had never made a penny of profit were valued in the billions. And if you asked investors why they were buying these stocks, they would say, the internet is the future. And again, they were right. The internet was the future. But that did not mean every internet company was a good investment. I remember seeing companies that were nothing more than a website and a dream being valued higher than well-established, profitable businesses. And I would scratch my head and think, what am I missing here? But the answer was, I was not missing anything. The market had just gone crazy. And you know what the sad part was? A lot of those investors knew they did not understand what they were buying, but they bought anyway because everyone else was doing it. They did not want to look stupid. They did not want to be the only one not making money. So they abandoned the one rule that would have saved them. Only invest in what you understand. Now, my old teacher, Ben Graham, used to talk about Mr. Market, and I think this is a useful way to think about investing. Ben said, you should imagine that you are in business with a partner named Mr. Market. Every day, Mr. Market comes to you and offers to either buy your share of the business or sell you his share. And the price he quotes changes every single day based on his mood. Some days, Mr. Market is optimistic and he quotes you a very high price. Other days, he is pessimistic and he quotes you a very low price. Now, here is the thing. You do not have to accept his offer. You can just ignore him. You only do business with Mr. Market when the price makes sense to you. But here is the problem. If you do not understand the business, how do you know if Mr. Market's price is fair or not? You do not. You are just guessing. And when you are guessing, you are not investing. You are gambling. I have never had a problem with gambling, by the way. If people want to go to Las Vegas and play blackjack, that is their business. But they should know that is what they are doing. They should not confuse it with investing. When you invest in something you understand, you can look at Mr. Market's offer and say, no, thank you. That business is worth more than you are offering. Or you can say, yes, I will take that price. That is a bargain. But when you do not understand what you own, you are at Mr. Market's mercy. You have to trust his judgment instead of your own. And let me tell you, Mr. Market is not someone you want to trust. He is manic depressive. He panics. He gets euphoric. He is not rational. So let me ask you this. What does it really mean to understand a business? Because I think a lot of people have a superficial understanding and they mistake that for real knowledge. Let me give you a test. If someone asked you to explain the business you are invested in, could you do it without using jargon? Could you explain it to a 10-year-old? If you cannot do that, then you probably do not understand it as well as you think you do. When I say I understand a business, here's what I mean. I understand how it makes money, not just they sell products and people buy them. I mean, I understand the unit economics. I know what it costs them to acquire a customer. I know what their profit margins are. I know whether those margins are sustainable or if competition will erode them. I understand the competitive position. Who are their competitors? What advantages does this company have that will still be there in 10 years? Is it a brand? Is it a cost advantage? Is it a network effect? Is it a patent? And whatever that advantage is it durable or can someone come along and disrupt it? I understand the management. Are they honest? Are they competent? Do they allocate capital well? Do they treat shareholders as partners or do they treat the company as their own personal piggy bank? I understand the industry dynamics. Is this an industry that is growing or shrinking? Is it fragmented or concentrated? Are the economics attractive? Or is it a tough business where everyone struggles to make money? And I understand the risks. What could go wrong? What would cause this business to fail? Is it regulatory risk, technology risk, competition, changes in consumer behavior? Now, that might sound like a lot, and it is. Understanding a business takes work, real work. You have to read financial statements. You have to study the industry. You have to think about the future. You have to use your judgment. But here is the thing. If you are not willing to do that work, then you should not be picking individual stocks. You should just buy a low-cost index fund and call it a day. And there is no shame in that, by the way. That is what I have told most people to do. Because for most people, trying to pick individual stocks when they do not understand the businesses is a losing game. Let me tell you a story that I think illustrates this perfectly. In the late 1990s, I got asked over and over again why Berkshire was not buying technology stocks. Everyone else was. The market was going up every day. People were making money hand over fist. And here I was, sitting on the sidelines with a portfolio full of boring old businesses like insurance companies and furniture stores. And people thought I had lost my mind. They said I was too old, too out of touch, that I did not understand the new economy. And articles were written about how Berkshire Hathaway was finished, how value investing was dead. But you know what? I slept just fine at night because I knew something very simple. I did not understand those businesses. I could not figure out which internet companies would be winners and which would be losers. I could not predict which technology would win. I could not value businesses that had no earnings and no clear path to profitability. And so I said, I will pass. Not because I thought the internet was unimportant. I knew it was important, but I also knew that I did not have an edge in understanding those businesses. And if you do not have an edge, you should not be playing the game. Now, what happened next? Well, the NASDAQ peaked in March of 2000, and then it fell. It fell 78% over the next 2 years. Companies that had been worth billions became worth nothing. Life savings were wiped out. And all those people who thought I was a dinosaur, a lot of them learned a very expensive lesson about the importance of understanding what you own. Meanwhile, Berkshire kept chugging along. We owned businesses we understood, businesses that made real products, earned real profits, and did not depend on some speculative vision of the future. And we did just fine. You know, one of the hardest things for people to do is to say, I do not know. We live in a culture where you are supposed to have an opinion on everything, where admitting ignorance is seen as weakness. But in investing, admitting what you do not know is a strength. I have been asked thousands of times about businesses outside my circle of competence, and my answer is always the same. I do not know. People ask me about biotechnology companies. I do not know. They ask me about cryptocurrency. I do not know. They ask me about which artificial intelligence company will win. I do not know. And I am not embarrassed by that. In fact, I think it is one of my strengths. Because when I say I do not know, I am also saying I am not going to lose money on something I do not understand. Charlie Munger, my partner for over 50 years, used to say that we have 3 boxes for investment ideas: in, out, and too hard. And you know what? The too hard box is the fullest one. Most businesses go in the too hard box, and that is okay. We do not need to understand every business to be successful investors. We just need to understand a few really well. Now, some of you might be thinking, well, Warren, if my circle of competence is small, am I just stuck? Can I never learn new things? And the answer is, of course, you can expand your circle, but you have to do it the right way. Expanding your circle of competence takes time, real time. It is not something you do over a weekend by reading a few articles. It is not something you do by watching a YouTube video or listening to a podcast. It takes years of study and experience. Let me give you an example. I did not understand technology for most of my career, and I was fine with that. But over time, I started to understand certain technology businesses better. Not all of them, but some of them. And eventually, I felt comfortable enough to invest in Apple. Now, why Apple? Because by the time I invested, I did not look at Apple as a technology company. I looked at it as a consumer products company. I understood the brand loyalty. I understood the ecosystem. I understood why people kept buying iPhones year after year. I understood the switching costs. That was something I could get my head around. But I did not invest in Apple because someone told me it was a good stock. I did not invest because it was going up. I invested because I had spent years watching the company, studying the business, and slowly building my understanding until I felt comfortable that it was within my circle of competence. That is how you expand your circle. Slowly, carefully, with a lot of study and a lot of humility. You do not expand your circle by chasing hot stocks. You do not expand it by investing in something just because it is trendy. And here's the other thing. Your circle does not have to be big. You do not need to understand 100 different industries to be a successful investor. You just need to understand a few really well. And when you find good businesses within your circle, you invest heavily in them. You do not diversify into things you do not understand just for the sake of diversification. Let me walk you through a few examples from Berkshire's portfolio. These are businesses I understand, and I want you to see what I mean by that. Take Geico, our car insurance company. Now, insurance might sound boring to some people, but I understand it. I understand that people need car insurance. I understand that Geico has a cost advantage because they sell directly to customers instead of using agents. I understand that this cost advantage lets them charge lower prices, which attracts more customers, which spreads their fixed costs over more policies, which lowers their costs even further. It is a virtuous cycle, and I can explain that to anyone. Take See's Candies. We bought that business in 1972. It is a simple business. They make candy. People love the candy. They have strong brand loyalty, especially around holidays. They can raise prices a little bit every year without losing customers. The business does not require a lot of capital investment. I understand every aspect of that business. There is no mystery to it. Take the Burlington Northern Santa Fe Railroad. Railroads have been around for over 150 years. I understand how they make money. They move freight from one place to another. They have a network that is very expensive for anyone else to replicate. They benefit when the economy grows because more goods need to be shipped. It is not complicated. Now, contrast that with some of the investments people have made in recent years. Cryptocurrency, for example. Can you explain how Bitcoin creates value? Can you explain why it should be worth $30,000 versus $3,000 versus $300,000? Can you explain what gives it intrinsic value? I cannot. And I have listened to plenty of smart people try to explain it to me. But at the end of the day, I do not understand it, and therefore I do not invest in it. Maybe I am wrong. Maybe Bitcoin will go to $1 million. But I can sleep at night knowing that I did not invest money in something I did not understand. Now, let me address something that confuses a lot of people. They hear about a company that is growing fast, and they think that automatically makes it a good investment. But growth and speculation are not the same thing as investing. Yes, growth is good. All else being equal, I would rather own a business that is growing than one that is shrinking. But growth by itself does not tell you whether something is a good investment. You have to ask, do I understand where that growth is coming from? Is it sustainable? And most importantly, what am I paying for that growth? I have seen people pay absurd prices for growth. They will buy a company trading at 100 times earnings because it is growing at 50% a year. And when you ask them, what happens if growth slows down? They do not have a good answer. They just assume growth will continue forever. But growth always slows down eventually. Competition shows up. Markets mature. The easy gains get picked off. And when growth slows, those high-priced stocks get hammered. This brings me to another critical point. Even if you understand a business perfectly, you can still make a bad investment if you pay too much. Understanding what you own is necessary, but it is not sufficient. You also have to buy at the right price. I have said this many times. Price is what you pay. Value is what you get. And you need to understand both sides of that equation. You need to understand the business well enough to estimate its value. And then you need to have the discipline to only buy when the price gives you a margin of safety. What is a margin of safety? Well, it is the difference between what something is worth and what you pay for it. If I think a business is worth $100 per share, I do not want to pay $100. I want to pay $70 or $60. That gap, that cushion, is my margin of safety. It protects me if I am wrong in my analysis. It protects me if the business hits a rough patch. It protects me if the market goes down. But here is the thing. If you do not understand the business, you cannot calculate its value. And if you cannot calculate its value, you have no idea whether you are getting a margin of safety or not. You are just hoping. And hope is not an investment strategy. I see people do this all the time. They buy a stock because it went up. They figure, well, it went up 20% last month, so it must be good. But that is backwards thinking. The fact that a stock went up does not tell you anything about whether it is a good investment today. In fact, it might mean it is now overpriced. When I look at a business, the first question is, do I understand it? The second question is, what is it worth? And the third question is, what is the market asking me to pay? Only if I have good answers to all three questions do I consider investing. Every few years, there is some new trend that everyone says is going to change everything, and maybe it will. But that does not mean you should invest in it if you do not understand it. In the 1960s, it was the Nifty 50 stocks. These were supposedly the 50 best companies in America, and people said you could just buy them and hold them forever. They were trading at 50, 60, 70 times earnings, and people bought them anyway because they were sure these companies would dominate the future. Well, guess what? A lot of those companies did dominate, but the investors still lost money because they paid too much. Even a great business is a bad investment if you overpay. In the 1980s, it was Japanese stocks. Everyone said Japan was going to take over the world. The Japanese stock market went up and up and up, and American investors piled in. Even though they did not understand Japanese accounting, did not understand the business culture, did not understand the economic dynamics, they just knew Japanese stocks were going up and they wanted in. And then the Japanese market crashed. It lost 80% of its value, and it still, to this day, has not gotten back to where it was in 1989. That was over 35 years ago. In the 2000s, it was housing. Everyone said housing prices could never go down. People were buying homes they could not afford with mortgages they did not understand. They were speculating on real estate like it was a slot machine. And we all know how that ended. And today it is artificial intelligence. Or maybe it is electric vehicles. Or maybe it is some new social media platform. I do not know what the hot trend will be by the time you watch this video. But I promise you, there will be something. There is always something. And my advice is the same as it has always been. Do not invest in it unless you understand it. Do not invest in it just because it is exciting. Do not invest in it just because your neighbor is making money on it. And do not invest in it just because you are afraid of missing out. Let me tell you something about human nature. We are social creatures. We want to fit in. We want to be part of the group. And when everyone around us is making money on something, we feel left out. We feel stupid. We feel like we are missing the party. And that feeling, that fear of missing out, is one of the most expensive emotions in investing. It causes people to abandon their principles. It causes them to invest in things they do not understand. It causes them to pay prices that make no sense, all because they do not want to feel left out. But you know what? Being left out of a bubble is a good thing. Missing a mania is a good thing. When everyone else is losing their minds, sitting on the sidelines is exactly where you want to be. I missed the dot-com bubble, and I am glad I did. I missed the housing bubble, and I am glad I did. I have missed plenty of hot stocks over the years, and I have never regretted it. Because I would rather miss out on gains I do not understand than suffer losses on investments that were never sound to begin with. You know what the beauty of staying within your circle of competence is? It teaches you patience. And patience is one of the greatest advantages an investor can have. When you only invest in things you understand, you are not constantly chasing the next hot stock. You are not jumping from one trend to another. You are waiting for the right business at the right price within your area of expertise. And that waiting, that patience, is what separates successful investors from gamblers. I have said before that the stock market is a device for transferring money from the impatient to the patient. And I believe that with every fiber of my being. The impatient investor is always doing something, always trading, always chasing, always worried about what they are missing. And all that activity costs them money in taxes, in fees, in bad decisions. But the patient investor waits. They wait for years if they have to. They wait until they find something they understand at a price that makes sense with a margin of safety. And then they buy it and hold it. They do not check the stock price every day. They do not panic when it goes down. They just own a piece of a good business, and they let that business compound over time. Now, I will tell you, this is not easy. Patience is hard, especially when you see other people getting rich quick on things you do not understand. But I have never seen anyone build lasting wealth by being impatient. I have never seen anyone build lasting wealth by investing in things they do not understand. But I have seen plenty of people destroy wealth that way. The question you should ask yourself. So let me ask you a question, and I want you to really think about this. Look at your portfolio right now. Look at every stock you own, every fund, every investment, and ask yourself, do I truly understand this? Not, do I know the name of the company? Not, do I use their product? Not, did someone tell me it is a good investment? But do I truly understand how this business makes money? Do I understand its competitive position? Do I understand the risks? Could I explain this business to someone else without using jargon? If the answer is no, then you need to ask yourself why you own it. Because if you do not understand it, how do you know it is a good investment? How do you know what it is worth? How will you know when to sell it? How will you know if something has changed? You will not know any of those things. You will just be along for the ride, hoping it goes up, and that is not investing. That is gambling. Now, if you go through this exercise and you realize you do not understand most of what you own, do not feel bad. You are not alone. Most people do not understand their investments, but now you have a choice. You can either take the time to learn and understand those businesses, or you can simplify. Sell the things you do not understand. Put the money in a low-cost index fund, and focus your energy on the few things you do understand. There is no shame in simplicity. In fact, I think simplicity is one of the most underrated virtues in investing. The simpler your portfolio, the easier it is to understand. The easier it is to understand, the better your decisions will be. And the better your decisions, the better your results. Now, some people will say, but Warren, I need to diversify. I need to own a lot of different stocks to spread my risk, and I understand that argument. But there is a difference between smart diversification and ignorant diversification. Smart diversification is owning several businesses that you understand in different industries so that if one hits a rough patch, your whole portfolio does not collapse. That makes sense. Ignorant diversification is buying a little bit of everything, including lots of things you do not understand, just for the sake of owning more stocks. That does not make sense. That is not reducing risk. That is just spreading ignorance across more investments. I would rather own 3 businesses that I understand deeply than 30 businesses where I only have a superficial understanding. Because with 3 businesses I understand, I can make informed decisions. I know what I own and why I own it. But with 30 businesses I do not really understand. I am just guessing. And when you are guessing, you are going to make mistakes. Charlie and I have always believed that if you have a lot of good ideas, you should put a lot of money in your best ideas, not spread it thin across mediocre ideas. Now, that does require you to really understand what you are investing in. It requires confidence born of knowledge, not arrogance born of ignorance. But if you have done the work, if you truly understand the businesses, then concentrating in your best ideas makes sense. Here is something else that staying within your circle of competence gives you: a long-term perspective. When you understand a business, you can see past short-term fluctuations. You can see through market noise. You can hold through volatility because you know what you own. But when you do not understand what you own, every piece of bad news is terrifying. Every stock price drop makes you panic. You do not know if it is a temporary setback or a permanent problem. And so you sell at exactly the wrong time. I have owned Coca-Cola stock since 1988. That is over 35 years. And in that time, there have been plenty of ups and downs. There have been quarters where sales disappointed. There have been times when people said soda consumption was declining. There have been market crashes where the stock price fell. But I never panicked. Why? Because I understood the business. I understood that Coca-Cola has one of the most valuable brands in the world. I understood that they had a distribution system that reached every corner of the planet. I understood that people were still going to drink Coke, even if consumption patterns shifted a bit. I understood the economics of the business. And so I held on. And you know what? That patience paid off. Not just in the stock price going up, but in the dividends that kept rolling in year after year, growing over time. That is the power of understanding what you own and holding it for the long term. So let me give you some practical advice. What should you do if you want to follow this principle of only investing in what you understand? First, start by making an honest assessment of what you actually know. Write down the industries you understand. Write down the types of businesses that make sense to you. Maybe you work in healthcare, so you understand hospitals or medical devices. Maybe you worked in retail, so you understand consumer behavior. Maybe you're an engineer, so you understand manufacturing. Whatever it is, start there. That is your circle. Second, commit to expanding that circle slowly and deliberately. Pick an industry or type of business you want to learn about. Not because it is hot, not because it is going up, but because you are genuinely curious and willing to put in the work. Then read annual reports, read industry publications, read books about that industry, talk to people who work in it. Spend years if you have to. Do not rush it. Third, be ruthlessly honest with yourself about what you do not understand. If someone pitches you an investment and you do not understand it after they explain it, do not invest. If you read about a company and the business model confuses you, do not invest. If you cannot explain to someone else how the company makes money, do not invest. No exceptions. Fourth, do not be afraid to say no. You are going to see a lot of opportunities that are outside your circle of competence, and that is fine. Let them pass. You do not need to invest in everything. You just need to invest in the right things, and the right things are the ones you understand. And fifth, remember that this is a lifetime practice. Your circle of competence today is not going to be your circle of competence in 10 years. You are going to keep learning, keep growing, but always with that same discipline. always with that same honesty about what you know and what you do not know. I am often asked what the secret to my success has been, and people expect me to give them some complicated formula, some special insight that nobody else has. But the truth is much simpler than that. The secret is that I have stayed within my circle of competence. I have invested in businesses I understand. I have been patient. I have been disciplined. I have been honest with myself. And I have avoided the temptation to do things I do not understand just because everyone else is doing them. That is it. There is no magic. There is no secret sauce. It is just common sense applied consistently over a very long period of time. But here is the thing about common sense. It is not that common. Most people know they should not invest in things they do not understand. But they do it anyway. They get caught up in the excitement. They get caught up in the fear of missing out. They abandon their principles, and they pay the price. You do not have to do that. You can be different. You can be patient. You can be disciplined. You can stay within your circle of competence. And if you do, I promise you, your results will be better than 90% of investors out there. Not because you are smarter, not because you have some special advantage, but because you have avoided the big mistakes. You have not lost money on things you do not understand. You have not panicked and sold at the wrong time. You have not chased trends. You have just owned good businesses that you understand, bought at fair prices, and held them for the long term. That is the path to wealth, not get-rich-quick schemes, not hot stock tips, not complicated trading strategies, just simple, patient, disciplined investing in things you understand. So let me leave you with this. The next time you are tempted to invest in something, ask yourself one simple question. Do I truly understand this? Not, is this exciting? Not, is this going up? Not, is everyone else buying it? But do I understand it? If the answer is yes, if you have done the work, if you understand the business and the price makes sense, then go ahead, invest with confidence. But if the answer is no, if there is any doubt, if you are just hoping it works out, then walk away. There will always be another opportunity. There will always be another investment. But there is only one you and only one portfolio. Protect it, respect it, invest it wisely in things you truly understand. That is my number one warning. That is my number one rule. And it is the one rule that, if you follow it, will save you more money and more heartache than anything else I could ever tell you. Stay within your circle of competence. Know what you know what you do not know, and have the courage to act accordingly. Thank you for listening, and I wish you all the best in your investing journey.